Trading is not just about technical and fundamental analysis. It is equally a psychological challenge that requires emotional discipline. While data-driven strategies help guide decision-making, emotions and cognitive biases can often lead traders to make impulsive or irrational choices. Recognizing and managing these psychological factors is crucial for consistency and long-term success in the financial markets. This lecture will explore key emotional and cognitive biases that affect traders and provide practical strategies to mitigate their impact. Emotions play a significant role in trading, influencing decision-making and often leading to irrational behavior. Two of the most common emotional pitfalls are fear and greed. Fear can cause traders to exit trades too early, avoid taking necessary risks, or suffer from the fear of missing out, leading to impulsive decisions. On the other hand, greed can push traders to over-leverage, ignore risk management, and chase excessive returns without proper analysis. For example, a trader holding a winning position may refuse to take profits due to greed, expecting higher gains, only to see the market reverse and experience regret and emotional distress. Overconfidence and impulsivity are two psychological traps that can lead to poor trading decisions. Overconfident traders may believe they can accurately predict market movements, causing them to take excessive risks. Impulsivity, on the other hand, leads traders to make decisions without proper research, often influenced by market noise or external opinions. For example, a trader experiencing a winning streak might assume they have mastered the market and increase their position sizes recklessly, only to suffer significant losses when conditions change. Recognizing and controlling overconfidence and impulsivity is essential for maintaining a disciplined trading approach. Cognitive biases are mental shortcuts that can lead traders to make irrational decisions, often without realizing it. One of the most common biases is confirmation bias, where traders seek out information that supports their existing beliefs while ignoring contradictory evidence. This can result in overconfidence and poor market predictions, as traders only focus on data that aligns with their views. For example, a trader who is bullish on a stock may only read positive news about the company while disregarding negative reports, leading to an uninformed decision. Recognizing and overcoming confirmation bias is crucial for making objective and well-balanced trading choices. Loss aversion is a common cognitive bias that affects traders by making them fear losses more intensely than they appreciate equivalent gains. According to prospect theory by Kahneman and Tversky, traders may hold on to losing positions for too long, hoping the price will return to their entry level rather than cutting losses early. This often leads to larger financial setbacks, as traders ignore clear signals that indicate further decline. For example, a trader might refuse to close a losing trade despite technical indicators suggesting continued losses, turning a small setback into a major financial loss. Overcoming loss aversion requires discipline and a clear risk management strategy to exit trades when necessary. Recency bias is a psychological tendency where traders give more importance to recent events while ignoring long-term market trends. This can lead to overreactions to short-term price movements, causing traders to make impulsive decisions rather than following a well-thought-out strategy. For example, a trader who recently experienced a market crash might become overly cautious, fearing another crash and missing out on profitable opportunities. This bias can prevent traders from seeing the bigger picture and making rational, long-term investment decisions. Overcoming recency bias requires focusing on historical data, maintaining a strategic outlook, and not letting short-term volatility dictate trading actions. Anchoring bias is a common cognitive bias where traders become fixated on an initial price or piece of information and use it as a reference point for decision-making. This can be dangerous because traders ignore new market data that suggests a different course of action. For example, if a trader buys a stock at $100, they may refuse to sell below that price, even if market conditions indicate that the stock is overvalued or declining. This mindset can lead to poor decision-making and unnecessary losses. Overcoming anchoring bias requires traders to stay flexible, adapt to new information, and make objective trading decisions based on the latest market conditions. Managing emotions and cognitive biases is essential for long-term success in trading. The first step is to recognize these biases, but the most important step is to implement strategies to mitigate their impact. One of the most effective ways to do this is by developing a structured trading plan. This involves defining clear entry, exit, and stop-loss levels before executing trades and establishing a risk-reward ratio to maintain discipline. For example, a trader might set a stop-loss order at 3% below the entry price and a profit target at 6% above, ensuring a consistent and rational approach to risk management. Practicing risk management is one of the most critical aspects of successful trading. A key principle is to limit the percentage of capital allocated to each trade, typically between 1 to 2% of the total portfolio. Additionally, diversifying holdings helps reduce exposure to a single asset or sector, minimizing the overall risk. For example, a trader managing a $50,000 portfolio might limit individual trade risk to $500, ensuring that a single bad trade does not significantly impact their overall account. Utilizing a trading journal is a powerful tool for improving decision-making and emotional control in trading. By keeping a detailed record of all trades, including rationale, emotions, and outcomes, traders can identify patterns and mistakes in their behavior. Reviewing past trades allows traders to analyze their strengths and weaknesses, helping them refine their strategy over time. For example, a trader may notice in their journal that impulsive trades often result in losses, prompting them to adopt a more disciplined approach moving forward. A trading journal serves as a guide, ensuring that traders learn from experience and make data-driven decisions rather than emotional ones. Using automated trading and algorithms is an effective way to remove emotional influences from trading decisions. Algorithms operate based on predefined criteria, ensuring that trades are executed objectively and consistently without being affected by fear or greed. Mechanical trading systems help traders stick to their strategies, eliminating impulsive decisions that often lead to losses. For example, a trader may implement an algorithm that buys stocks when the 50-day moving average crosses above the 200-day moving average, ensuring that trades are executed based on logic rather than emotion. Practicing mindfulness and emotional control is crucial for maintaining a calm and rational approach to trading. Techniques such as meditation, deep breathing, and visualization can help traders stay focused and composed under pressure. Additionally, taking regular breaks after a series of trades can help prevent emotional fatigue, reducing the risk of impulsive decisions. For example, a trader might take 5 deep breaths before executing a trade to clear their mind and assess the market objectively. By incorporating mindfulness techniques, traders can enhance their decision-making and achieve greater consistency in their performance. Gaining an educational foundation is essential for understanding emotions and biases in trading. Studying behavioral finance and market psychology provides valuable insights into how traders make decisions. Resources such as Daniel Kahneman's work on decision-making and books like Trading in the Zone by Mark Douglas help traders recognize and manage psychological influences. For example, a trader who understands loss aversion will recognize the tendency to hold on to losing trades too long and will take proactive steps to cut losses sooner. Taking the right actions is crucial for improving trading discipline and decision-making. First, it is important to review past trades and identify any emotional or biased decisions that may have influenced the outcomes. Implementing a strict risk management plan ensures that losses are controlled and capital is preserved. Keeping a trading journal helps traders track their decisions, emotions, and patterns, leading to better self-awareness. Additionally, using automated trading tools can help reduce emotional influence, and reading books on trading psychology and behavioral finance can further deepen your understanding of market psychology. Emotions and biases are an inevitable part of trading, but with awareness and discipline, their impact can be effectively managed. Successful traders recognize the psychological traps that influence decision-making and implement strategies to maintain rationality in their trades. By developing a structured trading plan, practicing risk management, and continually refining emotional control, traders can enhance their performance and increase their longevity in the markets. The key to success lies in understanding and managing emotions, ensuring that every trade is based on logic rather than impulse.